Hi there, Sensei here, helping you figure out what your next move is going to be. And when devising your plan A, whatever that plan A happens to be, try to be concise about the understanding of the amount of risk that you're willing to take. That way you don't slide back down the mountain. As we're living our lives, we're going to be confronted with making numerous decisions. Decisions of things that can or potentially might happen versus things that actually will happen. Now, in the financial world, no one actually has a crystal ball telling them exactly what's going to happen in the future. I mean, if we did, we'd all be millionaires or billionaires for that matter. But that's why it's so important to learn as much as we can and become as educated as possible. That way we can project and speculate with better accuracy towards our endeavors. So if you do happen to make a high-risk financial decision and it doesn't pan out the way you want it to, the younger you are, the better. And simply because you have time on your side to bounce back.
So if you fall back down the mountain due to some stupid decision that was either made voluntary or involuntary, simply get back up again.
Now, if you happen to make some stupid financial decisions and you're doing some couch surfing and things of that nature, it's okay to do that when you're younger, but try doing that when you're in your 60s or 70s. Try knocking on that friend's door at that time. See how that works out for you. Now, I used to help people with Medicare, and I've been in my fair share of skilled nursing facilities and nursing homes, and I got to say, there's this unrelenting amalgam of smells. Not all of them, but for a large portion of them, mixed of both pine sol and urine. And I got to say, if you really need to start thinking about a financial foundation as young as you can. And that way you're not reliant on other people making these decisions for you later in life. I mean, I have seen people who have allowed certain family members who might not be looking at your best interest, sell your home right out from underneath you. There's ways that people do this. So before you devise your strategy based on risk, understand all the reasons for why we go out to make money in the first place. I mean, we need to make money, of course, to put food on the table, to buy or rent a home, to clothe ourselves. But we also need to make money to rear our children and to hopefully give them enough stability and strength that they can go out and make money for themselves. But we also need to make money to take breaks, to celebrate, to entertain ourselves, to give back when necessary, and of course to do the things that make us smile. But we should never take life for granted. Always realize how fragile life can be. I mean, one moment you're here enjoying life with friends and family, and the next moment you could be gone. And death comes for us all, and we don't know exactly when that's going to be. So if you happen to be the breadwinner of your family, how will the lack of your existence affect the other people around you? Will your significant other lose the house? Will your children be unable to attend college or further their education? Or will your significant other simply be, pushed aside into some retirement home against their own will? This is why it's so important to lay the foundation of a good, sound, sturdy financial strategy that can not only help you accrue passive growth and compound it over time, but it also gives you the protection for why you got up to do all that hard work in the first place. I mean, we can't take the money with us, but if we're proactive, we can be damn sure of where that money goes. That's why it's very important to really consider permanent cash value life insurance in one of its various forms. Because you can accrue passive growth and protect your loved ones at the same time, in the same package deal. And in addition, if you happen to still be single and you're coming up with viable reasons for why you don't think you need a policy at this point in time of your life because you're still single, just remember that being young and healthy has its advantages with regards to premiums and life insurers. And having your own permanent life insurance policy lets the universe know that you're a good, long-term, stable, and supportive catch for anyone to take on. So with regards to risk, the last video I presented was discussing a form of cash value life insurance known as whole life insurance. Now keep in mind that this description is not quantifiable data and it's more of my interpretation regarding risk as if it was determined on a Likert scale. Now if you recall, whole life is one of the least risky of the financial tools, offering both predictability and stability through a guaranteed death benefit, fixed premiums, guaranteed and non-guaranteed cash value growth, principal protection, spectacular tax advantages, and liquidity on your cash values. And if you remember, I also told you that it could be one of the most expensive. So, if you haven't looked at that video yet, go ahead and look back at that and make sure that you understand both payment risk and MEC limit risks. So today I'd like to talk to you about another form of cash value life insurance. And instead of offering greater stability and predictability via whole life insurance, this form of cash value life insurance offers greater flexibility with the potential for greater growth. Now keep in mind the word greater potential here. Now, with all things that have a potential for greater financial growth comes at a greater risk, which equates to generally less guarantees. This form of cash value life insurance is known as universal life insurance. But first, let me describe to you how this insurance came to be, and you can figure out if this is the proper plan A for you. Now, if you recall, I described whole life insurance by purchasing a series of 10-year term policies over an individual's lifetime, all the way up until their deaths, where the cost of insurance goes up in direct relation to the individual's age, along with other well-being factors. So as we go closer to our inevitable deaths, the cost of insurance is essentially going up. Now, the reality is that you can't purchase this many term policies over your lifetime. The actuaries who have been hired by the insurance companies determine that once you reach a certain age, no matter how healthy you are, you're too much of a liability for the life insurance company. So the point I'm trying to make here is that if you could purchase all these separate term policies over your lifetime, it would represent the true cost of insurance. Insurance companies devised a form of insurance where you paid beyond the cost of insurance. This allowed you to build up a reserve for your own policy, as instead of renting the policy, now you're creating an ownership of your policy. The reserves or additional funds will begin to accrue in your policy as it's tied to the life insurer's general account, and it's going to continue to compound over time. Now, this is merely a quick recap of my last video again, so take a look at that to have a better understanding of all the benefits associated with whole life and cash values, foundation of all permanent life insurance.
So how did universal life come to be?
So there's a small portion of people who purchased whole life insurance policies without considering one of the biggest risks: payment risk. You see, some of these folks purchased these policies, funded them, watched their guaranteed interest grow, compound over the years, and then chose to take out too many loans or withdrawals against the policy without even considering the base cost of insurance. The base cost of insurance itself is tied to mortality tables, and as you are stripping away or borrowing against the policy too often without the intent of refunding those funds back into the policy, the purpose of growing cash values from an insurance perspective is to offset the difference for the rising cost of insurance in your later, generally less healthy years of life. By diminishing the cash values too much without the intent of refunding the policy along the way, the policy owner is inadvertently causing the cost of insurance to inflate, because now there's more of the insurance company's money to insure as opposed to your own, which was built inside of your policy. This excessive borrowing against the policy without the goal of refunding the policy, in turn, would cause this type of policy to lapse. Now, some other people were doing as they were supposed to, paying into their policies as agreed upon, and doing all the necessary things to keep their policy in force. But then some of them actually, became critical or had some sort of disease or something which physically made them unable to continue to pay their premiums. Now, once you stop funding a whole life policy for any reason, the policy itself will remain solvent for a period of time as it slowly strips away the cash values. The cash values will then be diverted to cover the base cost of insurance. Once the cash values have depleted and the cost of insurance has caught up with the current value of the policy, again, this policy could lapse. This is why it's so important to know your objectives before purchasing any form of life insurance policy. And remember, the cool thing about owning your own policy is that you can actually cash out your own policy if you want to for a small fee and gather up all that compounding principal growth your policy has been accruing over the years. Keep in mind you want to do this before your base premium costs will spiral out of control. In addition, just know that there are various riders that you can actually attach to your policy to help mitigate any of these concerns that might haunt you. For example, for a small monthly fee, you can actually add a waiver of premium disability rider, which some carriers offer, not all, which means that if you're deemed totally disabled by a physician and you've been paying into your policy and this happens to you, the policy is actually flips on this rider and it's considered paid up and no more premiums are required. You see, insurance companies know how to insure every freakish aspect about your policies so that it's crafted to fit your needs. And with regards to the most life insurance policy required in this day and age, if you were ever deemed terminal by a medical physician, you can actually tap into 90% of the death benefit. Not the cash values, but the death benefit while you're living to help pay for additional costs that your health insurance is not covering, and even some living expenses that you can't come up with. So that means that, for example, if you had $1 million, and you were deemed terminal, you could literally tap into $900,000 of that $1 million to live out your remaining life under your own terms.
Sensei, simply get on with it.
Now I know I'm stretching this out a little bit, and I'm going to try my best to get back to how universal life insurance emerged. So seeing these types of lapses with whole life insurance, the insurance companies were left with a conundrum. Some people overextended themselves while others simply became ill and could no longer afford to pay their premiums. Whole life policies had a fixed premium and a fixed guaranteed death benefit, which was essentially set in stone via the contract. So, what if the life insurance companies could come up with a form of permanent insurance that allowed more leeway? In the 1980s, universal life insurance emerged, allowing policy owners the flexibility to make adjustments throughout the life of the policy. This, of course, was subject to the terms and conditions of the insurer, but essentially the companies were able to unbundle some of the risks that they normally managed and place those risks in the hands of the policy owner. Some of the notable attractions about a universal life policy are that the premiums are much, much lower than that of a whole life insurance policy, where you can still have cash value growth and the policy remains permanent without any reevaluation of health conditions in the same way that you would need to with the term policies over. And as long as the minimum base target premium was met, there doesn't need to be more cash values built in the policy than necessary. So if hard times occurred and the ability to make future payments diminished, the policy owner had the flexibility to adjust the policy to the contract. And let's say that it was a $1 million universal life policy and you ran into some financial difficulty. You actually had the ability to reduce that death benefit down to, say, a $750,000 policy, and at the same time lower your base cost of insurance, cutting down on various fees and administrative costs and so forth, allowing you some time to free up and actually miss some payments if you wanted to. Be sure that you understand where those costs are coming from before you make such a move. And keep in mind that this is just an example of the flexibility of how a universal life policy works. Another attraction about a universal life policy, and it's dependent on the carrier, is that they allow different ways of crediting interest to the side account. Now, most carriers offer a guaranteed rate that is set by the insurer and is generally lower than the potential growth that the policy can actually perform at. Other insurers offer a current interest rate, and over time, these interest rates can vary as well. And some carriers offer interest rate tied to an indice or a group of indices, such as the S&P 500 or the NASDAQ, which allows for the potential for greater growth. Now, remember earlier when I raised the point with regards to potentially higher growth? This is exactly the point that needs to be understood in relation to a universal life policy, because the rates might be guaranteed and or subject to change, but overall, cash value inside of a universal life policy, it's not guaranteed. This gives the policy the potential for higher interest growth, although if the interest rate connected to the policy does poorly, the interest growth could potentially set your side account back. Now this is counter to the way a whole life insurance policy works, where the interest growth is guaranteed and tied to the insurer's general account. Thus, overall, universal life insurance is a higher risk financial tool. A quick verbal recap. The biggest thing to think about when purchasing a universal life policy is payment risk. Universal life policies have an attractive annual premium, significantly less than that of a whole life policy. The cash values are tied to a method of interest crediting that is stipulated in the contract and is subject to change. Cash values inside of a universal life policy are not guaranteed, despite a guaranteed interest rate. If the method of interest credited is tied to an indice, for example, the growth is subject to the volatility of that indice or group of indices, like the S&P 500. This in turn will either increase your cash value growth if the market is doing well, or reflect poorly if the indices are performing poorly. When we acquire our policies in our early years of life, the true cost of insurance is much lower, but once we get closer to the age of 70, the true cost of insurance becomes much, much higher. You might have a lower annual premium when you're younger, but if you haven't accrued enough cash values inside of the policy in your later years because of market volatility, this type of policy could lapse. Meanwhile, you were paying into the policy the same annual premium you were paying when you were younger, not considering the cost of insurance being higher in your later years. This type of policy is a permanent policy that can give a death benefit without undergoing continued underwriting, and as long as you understand that you might have to pay more in some years to keep this type of policy solvent, then, if you want to pay the least amount for a life insurance policy and it remain permanent in your earlier years, this could be your policy. Just know that in your later years of life, the current premiums that you're paying might have to be adjusted higher just to keep the policy in force. And if you're not working, factoring in a higher premium later in life might be difficult. So if you're the type of person who likes to set it and forget it, I generally don't recommend a universal life policy. Remember, this type of policy came to be by unbundling some of the risks that the insurers normally managed and putting them into the hands of the policyholder. By taking too many loans and withdrawals while your policy is in its building stages and not paying back into the policy could affect the cash values in a way that could inadvertently cause this policy to lapse, especially in your later years of life when this type of policy is needed the most. I compare this to like trying to fill up a swimming pool while there's a big huge gaping hole at the bottom of the pool. Keep in mind, the more cash values that you have built up inside of your policy, the less money your insurance company is actually insuring, which makes up the total death benefit difference. But if you're the type of person who likes to continually tinker with their policy and are able to actively balance the risks, this type of policy can be attractive. It has the built-in flexibility to squeeze down the death benefit or miss some payments, and to do it with less upfront annual premiums compared to that of a whole life policy. Although because this risk is placed in your hands, I recommend paying a little bit more than you're normally paying in your earlier years, in those first 4 to 7 years, all the way up to the MEC limit. That way that your policy can accrue and compound. Now, if the cash values begin to diminish later in life, hopefully the extra funding that you've done, combined with the compounding effects, will offset this type of risk. Just get in the habit of assessing your policy every year and contact the insurer and request an as-is illustration, which will be based on the current assumptions and conditions of the policy at that time. This can be used as a tool to help project potential outcomes, giving you a better informed decision as it relates to how you are actively managing the policy. And remember that all illustrations are based on current assumptions and conditions, which might differ significantly from the actual policy. This is due to changes in interest rates, policy expenses, mortality experience, and other factors. So if you're a shaker and a mover and you've seen enough and like the idea of owning a universal life policy, feel free to check out my quote and apply platform in the description below. Simply plug in some basic information to acquire a quote between numerous different carriers. You can design the policy based on your needs, and voila. If you like what you see, you can apply right then and there. You'll then be asked to schedule your blood test and any other additional tests that the insurance company might require of you based on the questions that are answered. And what will happen is the medical professional will come out to see you, at a place of your choosing and a time of your choosing, and you don't have to really worry about these tests, this blood test, because they're bundled in your first year's premium. However, I also recommend acquiring a complete physical prior to this test. That way you know enough about your body to represent the healthiest you. Now, after the health results are in, the quote will be reevaluated up or down, depending on how healthy you truly are. If you have any issues, please email me. Let's begin a dialogue and just see if we're fit for one another. Now, I'm currently taking applications from the states of New York, Virginia, and Florida. And be on the lookout for my next video as I describe how guaranteed universal life emerged, then followed by index universal life, and see overall which of these forms of life insurance makes the best proper plan A for you. And as I said before in my previous video, our nation has put sanctions on Russia, and Russia, along with many of their wealthy yacht-owning oligarchs, who might be looking for ways to fraudulently grow their wealth, which could include purchasing a life insurance policy. And just know that I'll be checking the every policy owner's request and see if their name is on the ICIJ investigations list. And ultimately, your request to acquire a policy through me, if you happen to be an oligarch, will be denied. So please don't even bother. I can't have funding the Ukrainian war and the deaths of all those innocent people, tied to me in any way. But for the rest of all my fellow Americans, and Russian Americans at that, please feel free to contact me. I'd love to have the honor of serving both you and your families, and help you figure out whatever plan A you decide on. And no matter what, keep climbing your own mountain. No one can do it for you. I hope this video has been informative for you, and giving you at least a direction to aim at with regards to your plan A. Take care and have a good rest of your day.